Jobs in April went up by 115,000. Like always, healthcare led majority of the job gains. Information services lost 13,000 jobs, and it's been a continuing trend. Since November 2022, this sector has lost 342,000 jobs, and it coincides with the rise of AI. That's about 11% loss of jobs. Unemployment rate held steady at 4.3%, no increase. And it's also good that the labor market has reached a point where only a modest amount of job creation is needed to keep employment rates steady. That also means as time goes by, there's no need for high number of jobs. Average hourly earnings, also one of the closely watched metrics for U.S. labor health, increased at 3.6% year-on-year. Not too bad. A fairly decent 0.2% month-on-month. But as consumer prices, now at 3.8% year-on-year, and personal expenditure start to catch up to this number, then you might see some impact on consumers. Some comments from Allianz. This report shows that April is fairly bulletproof, while the job market continues to soften, but it's not a collapse. Another comment. The U.S. economy is still quite resilient despite all of the ongoing concerns at Middle East. Till date, 89% of the 500 companies have reported earnings. Looking at the blended earnings growth rate, which means companies that reported plus those that haven't reported, the earnings growth rate is 27.7% year-on-year for quarter one. It's a very high, decent number, and excluding this quarter, the index already has 5 consecutive quarters of double-digit year-on-year earnings growth. It's still going strong, and that's also one of the reasons why majority of the people are still bullish in U.S. equities. 10 of the 11 sectors in total reported year-on-year earnings growth, and 7 out of those 10 reported double-digit earnings growth. Look at the chart at the right. Information technology, communication services, materials, and consumer discretionary. Healthcare is the only one that reported year-on-year decline in earnings. The high oil prices are likely weighing on freight export prices. Till date, 89% of the 500 companies have reported earnings. Looking at the blended earnings growth rate, which means companies that reported plus those that haven't reported, the earnings growth rate is 27.7% year-on-year for quarter one. It's a very high, decent number. And excluding this quarter, the index already has 5 consecutive quarters of double-digit year-on-year earnings growth. It's still going strong, and that's also one of the reasons why majority of the people are still bullish in U.S. equities. 10 of the 11 sectors in total reported year-on-year earnings growth, and 7 out of those 10 reported double-digit earnings growth. Look at the chart at the right. Information technology, communication services, materials, and consumer discretionary. Healthcare is the only one that reported year-on-year decline in earnings. The high oil prices are likely weighing on freight export prices. Looking at revenue, the blended revenue growth rate for quarter one is 11.3%. All 11 sectors reported year-on-year growth in revenue. The strong ones are, again, tech sector, communication services, and utilities. Looking ahead, analysts are quite bullish in the S&P and forecasting for quarter two 19.9% earnings growth, quarter three 23.2%, and quarter four 20.7% year-on-year growth, and for calendar year this year, a forecast of 21%. All of these are very strong numbers. It's a different story for Eurozone. Germany, the biggest economy in Euro area and the 5th biggest globally. They've already been struggling with industrial numbers before the Middle East war, and right now, it's the 4th consecutive month without growth in industrial production. The latest data points to March, with a drop of 2.8%, and Germany is buying more than selling. Exports growth slowed. Imports surged once again. This narrowed trade surplus a lot, down to the lowest since November last year, which isn't a good sign for GDP growth looking forward. The economy managed to grow a small 0.3% in quarter one. Looking forward, the outlook worsened again. The biggest reason is high energy prices. It doesn't help that Germany is one of Europe's largest net importers of energy. And also, energy-intensive industries employ nearly 1 million jobs. So when this industry is struggling, its labor outlook might be a little shaky, and not forgetting the latest U.S. tariff threat at about 25% tariffs on European automotives. That brings another hit to the already weak industrial sector. On to China. April exports rebound very strongly because buyers are seeking to stockpile supplies from China because of fears from Iran, war pushing global prices even higher. Exports expanded 14.1% year on year, a huge increase from March. Strong demand from overseas buyers, these external demands, have been one of the primary growth drivers for China, and this trend appears to be continuing this year. Imports increased too. But however, unlike Germany, China's trade surplus went up. This will support the overall GDP growth momentum. For inflation, headline consumer prices, April came in at 1.2% year-on-year. High energy prices are showing up. There's a 17.4% year-on-year price increase in energy for transportation. Looking at core inflation, excluding food and energy, it also increased. At the same number, 1.2% year-on-year. This shows that service inflation increased too, and not just energy prices. Services cover retail, restaurants, insurance, education, healthcare, and also rent. But for China, residential rents is an exception. It dropped a little at 0.6% year-on-year. The continued fall in rents suggests that the pressure still remains on property sectors. On to producer prices. It continues to increase. It's been the 9th consecutive month of increase and the 2nd straight month of positive PPI. The latest number, which is April, came in at 2.8% year-on-year. In general, raw materials, fuel, and power prices all increased. As the US-Iran war drags, these higher input costs for producers will likely feed to the economy, passing on to companies, and then eventually on to consumers. So next, unlike other central banks, China has room to cut interest rate. But when you look at the 5% year-on-year GDP growth in Q1, combined with the reflation momentum, very likely there won't be an interest rate cut soon. But nonetheless, they're still going well thanks to the external demand. And lastly, the latest news for US-Iran war. US rejected Iran's counter-proposal. Iran said they'll never bow down. Iran insisted for war reparations and full authority over Strait of Hormuz, end of sanctions, and rejected US demands regarding their nuclear program. And then for US and China, the two are expected to meet at a summit soon. We'll hope for the best news.